Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode, Jack and I welcome back Doug Clinton, managing partner at Deepwater Asset Management. We start by talking to Doug about the cycle of technology investing and the patterns that take shape when new technologies like artificial intelligence emerges and evolves over time. We get Doug's take on where we are in the current AI-driven cycle and the opportunities for investors. In the back half of the conversation, we talk to Doug about building investment strategies using ChatGPT and other AI engines and the results of those strategies so far. As always, thank you for listening. Please enjoy this discussion with Deepwater's Doug Clinton. Hi, Doug. Thank you very much for joining us again.
Great to be back, guys. Good to see you.
We wanted to have you on to talk about technology, of course, but I think we'll get into some discussion around AI, maybe the opportunities that exist today, and also sort of the constant evolution or sort of understanding technology cycles. And I think what investors, can learn from past history and your experience, I think in the technology space in general. And then if we have some time, we want to take the opportunity at the end to talk to you about some of the indexes that you're building using artificial intelligence. So for investors that are interested in sort of how the AI is being used to construct investment strategies, try to stick around because that's going to be on the back half if we have time. So really appreciate it. You're always so gracious with your time and it's been super thoughtful on a lot of these topics. I wanted to start with you and just reference a quote, and I'm not going to read it because it's way too long, but it's on your X handle. I think you have it pinned. And it's this quote from the Engines That Move Markets. And it's about understanding the cycles of technology, sort of boom and bust. So I think that's a good place to start. Could you just kind of walk us through what that quote is trying to express?
I can. And for anybody who is interested in sort of like understanding the normal pattern of technologically driven booms, Engines is a great book. It's written by Alistair Nairn, who is a UK-based investor. But the general idea of the quote is that these boom to bust cycles driven by technology all kind of follow this generally same pattern with investors. First, you have pretty much broad skepticism. Like everybody is, if they're not ignoring it, they actually disbelieve that this new technology is ever going to amount to anything. Then you sort of get this phase where you have some early optimists, maybe some technological breakthroughs happen, and some people in the market start to see there's opportunity there. I think that's probably where we are right now with AI, maybe in the middle to tail end of this sort of early optimist phase. Then you just get broad, right, market optimism. Everybody starts to believe, like you see the light bulb, you see electricity. We're not there yet with AI, but I think there will be a moment where everybody all of a sudden just grasps that, this is going to be profound. And then once you get that broad optimism, you get insanity. That's when you get the mania. That's when you get kind of the blow off top when you look at the charts in 2000, the bubble, and then of course you get the bust. So that's the genesis or sort of the meat of the quote is you go from skepticism, a little bit of optimism, everybody gets optimistic, too optimistic, and then bust.
How do you think someone can better learn to become an early optimist? Because to me, like I'm thinking of my own experience, like with some crypto stuff and even me trying to use ChatGPT in my daily sort of work life and production and what I do. Like, I feel like I have always tried to like embrace like those technologies, like when I see them, but I'm curious from your perspective. I mean, you guys have your finger on the pulse of like a lot of these new technology. I think before you just, were showing us the Apple Vision Pro thing that you have on the side of your desk. And I think like part of your job is, being one of those early optimists, but if, taking yourself out of your professional role, how do you think investors can better become early optimists and look at this kind of stuff?
I think it can be hard. Like, I actually think, like taking a step back from that broader question, I actually think people generally fall in one of two categories. Like they're either natural optimists or they're sort of natural skeptics or pessimists. And what I've found hard is I actually think naturally I'm more of the skeptic or the pessimist in many cases, which is probably an odd combination for a tech investor who I think most tech investors happen to be sort of natural optimists. So for me, I try to do exactly what you're asking about, Justin, by being curious, just going out and, like you mentioned with the Vision Pro, and it was, if we have video, it is sitting on my desk. I was using it a little bit yesterday. Just going out and like getting the new devices. In the case of AI, going out and I try every day, almost like exercise, to go and use some of the chat interfaces and just use the tools and see what they can do, try to make them do different things that are crazy. I had one experiment I ran with my wife actually, where we designed a handbag company, which was just random. We just thought it'd be fun, but we had Mid-Journey make and design kind of a cool looking handbag. And then we had ChatGPT like create the name and the brand and the story behind the handbag. So just go and try stuff. I think that's the best way to be optimistic. And then what I think you find is when you actually go and use the technology, instead of reading like secondhand what someone else is saying about it, you can figure out where you think stuff is real and not real. So we were talking before the podcast. I'm a little bit skeptical of the Vision Pro still. Like I've had it here, it's sat on my desk for 2 weeks, unused. It's just not a killer use case for me yet. And I think it's a really difficult thing for people to put on headsets, which we can talk about more if you guys want. So that one I'm skeptical of. But AI, and you mentioned kind of investing with AI earlier, that's something I've been experimenting with a lot, trying to really push the boundaries. And that's something I'm super optimistic on just from that experience.
Going back to the sort of cycle with technology companies and the engines that moves the market, where do you think we are with AI currently? Like what inning would you say?
I think we're probably around inning 4-ish, something like that. 3 to 5 would be my gut take right now. I think we're still, if we use that framework from engines that we elucidated before, something around that like early optimist cycle. I don't think we're in broad market optimism yet. I know some people do think so. I think the skeptics think we're like way further down the line than we really are. But I mean, ChatGPT, I think last I saw, it's like they have 100 million weekly active users. It's really not that many in the scale of things where the internet, right? I mean, we've got 4 or 5 billion people who use the internet every day. So the penetration of AI, like AI's most important product, is still super low. And so I think we have a long way to go before we get to, and I think we will get there, by the way, a mania driven by AI, but I think it's probably still 3 to 5 years away.
And just to get at the overall premise of your tweet before I ask about a couple more quotes you had in there, you think this has the potential to be significantly bigger than the dot-com bubble, correct?
I do think so, because right now the internet was connecting all of us really for the first time ever. And I think that interconnected nature helped some of the spike we saw then. Now we're already all connected. We're even more connected than we were 20, 25 years ago. And I actually think AI, in terms of the value it can create for the world, is bigger than what the internet ultimately did. So I think that necessitates we could have a bigger bubble.
Do you have any, like, if we think about like some of the mind-blowing things that this might do, like in terms of our everyday lives, do you have anything off the top of your head you can think of like the uses of this that maybe someone like me who's not in it or not realizing?
I'll give you 2. What's coming, I think, in the nearer term is this concept of AI agents. So like right now, we just have these chatbots that are pretty straightforward. You can ask a question, you can get an answer. In the near future, we will have bots that if you say, book travel for me to go on vacation to San Diego, the bot will understand your preferences, it will understand your calendar, it'll know your credit card information, and it will be able to perform actions for you in the real world. And ultimately, I think they'll be able to perform actions in the physical world. Hail an Uber for me, make sure my Uber's on time tomorrow morning to take me to the airport, things like that. So I think that's the next evolution that people will feel, and sort of it will impact their daily lives. The other thing, like I mentioned earlier, that I'm super excited about is using AI to actually make investments. And I know we'll talk a little bit more about that later, but I think we're going to see a world in the near future where AI is acting as a portfolio manager, acting as a stock picker. And I feel very confident that AI can beat markets now. And I think it will have a good chance of continuing to do that as the models get smarter.
You had another great quote in your tweet here. from Mark Twain. It is the changes that tell you how to pilot the boat, not stasis. And I was wondering if you could talk a little bit about how you think this situation might be different than some other things we've seen with tech booms in the past.
What I think is probably the biggest difference here, especially if I compare it to the internet, is the infrastructure needs. So I know people like to use kind of the parallel Cisco and the network build out in 2000 versus NVIDIA today, and sort of the compute build out. But the thing I think is different is that with the AI boom, like it is wholly dependent right now, and I think it will continue to be wholly dependent on the amount of compute that's available. So I mean, essentially, like compute is equivalent to intelligence. The more compute we have, the more machine intelligence we have. And until something changes in that paradigm, until somebody creates a model that, maybe is more efficient and uses data in a different way, and obviously there are people who are trying to figure that out. Until somebody does, I think we just have this natural and ever increasing demand for compute. And so I actually think as long as that happens, as long as that stays persistent, this infrastructure build out may last longer than people really realize. So I think that's the biggest thing that's different, is that we do have this this specific product, right, which is compute and all of the network infrastructure that goes around it, that we really need. And you could almost say there's like no practical limit to how much of that we might want, because more machine intelligence is good, I think, for the world.
It's interesting on that NVIDIA versus Cisco thing. There was this chart going around Twitter recently on this idea of like where we are, relative to the tech boom or the dot-com bubble with them. And if you looked at the chart, and I don't love like overlaying these charts from different time periods, I don't think it's the greatest thing, but it just did give you an idea. Like if you look at the chart, NVIDIA is like at the beginning of Cisco's ascent in terms of like mirroring the charts with each other. And also NVIDIA doesn't trade at anything close to the valuation Cisco traded at the top. So it just says for like value guys like me who say, well, this thing's over, we're in the ninth inning or whatever, this could go a long way to even be similar to what the dot-com bubble was.
It's really hard. I mean, you look at NVIDIA's chart and you go, whether it's year to date, I mean, it's up almost 100%. You pull back to a full year, it's up almost 300%, I think. And any rational human being would say, wow, that is scary to like buy it right now. What's funny is, as I've mentioned, like I've kind of experimented using AI to make investments. In one of the funds that I'm testing with AI, its top large cap pick has been NVIDIA for like 5 months straight. And I think what's telling for me when I think about that, like why is AI so excited about NVIDIA and why has it been so excited? Because AI was just looking at the fundamental realities of the business, the qualitative realities of the business. It wasn't looking at the stock chart. It actually doesn't have any comprehension of what a stock chart is. It could describe what one is to you, but like it's purposefully, I sort of don't let it have that data. And it was just saying, look, on the fundamentals, and if it grows like people think it's going to grow, you should own NVIDIA. And AI has been dead right. So I do think there's something in that where when you extract or you pull away some of the things that make humans bad at investing, emotion in particular, AI has an advantage there that could be hard to surmount.
Yeah, and to your point, like if you look at the actual like sales growth of NVIDIA, it's almost unprecedented for a company of that size. I mean, I think somebody was doing it the other day and they maybe came up with one or something, but to grow that fast on that size is pretty crazy.
Yeah, and it's followed, the stock chart has kind of followed the sales growth chart and ultimately the bottom line growth as well.
You had another quote, which I thought was great. This whole idea about genius and luck is something I've thought a lot about. And you have this quote from The Mind of Napoleon by J. Christopher Harold. It says, "It takes genius to be lucky." And I was wondering if you could talk a little bit about that, the relationship between genius and luck and how it related to this tweet on tech booms you were talking about.
I think the thing with genius and luck is, and I think the point that Napoleon was sort of trying to make is, like when you're a genius, you kind of put yourself into positions to be lucky. And I think other people have said that probably after him and before him too. Timeless lessons often are kind of retold in different ways. And I think as it pertains to investing around technological sort of innovations and booms, it doesn't take a genius to really say, okay, like AI is going to be this really big thing. It takes a little bit more intelligence to go deep on it and say, well, what are the components that are super important? What are the companies that are really going to benefit from this? And then just placing yourself ahead of that, even if you're too early, then I think you start to invite the potential for luck by actually being in the game, actually investing, maybe building companies in the case of some entrepreneurs. And then anything can happen. Luck can take hold. And I think when you're in the right technological paradigms, usually it's good luck, not bad luck, that kind of grabs you.
Have you ever heard about this idea of like serendipity versus luck?
No.
It's interesting. It plays into exactly what you're saying. It's something Jason Zweig talked about like on Patrick O'Shaughnessy's podcast like a long, long time ago. But the idea is like luck is if I just find oil in my backyard or something, like that's luck. But if I'm out meeting with people and, learning about my industry and doing all the right things, and I just happen to come across the right person at the right time that advances my career, then that's serendipity because I've put myself in position to get the luck versus just sitting here and hoping the luck would come to me. So I think that fits pretty well with what you're talking about.
I think it's a great way to put it, and I think the more back to the idea of curiosity too, I'll pull in that idea as well. I think luck can also be somewhat a byproduct of curiosity, or maybe serendipity is the better word for that. But I think the more curious you are as an investor and the more you play with new things in the world and try new products, whether it's tech products or retail products or soft drinks. I mean, we're invested in Celsius. It's a company in our core Titan fund. Just go out and be curious and try new things. And I think the more things you try, and the better of a barometer you get of like, okay, this is really different. This is special. This is real. I think that can help make you a better investor.
Yeah, especially in a world where we all get pigeonholed. I'm either a value investor or a growth investor. I'm on this side of the political spectrum or the other. Like we tend to, I think, try new things less or go outside of our comfort zone less. So I think that's really, really important in the world we're in today.
Absolutely. 100% agree.
So this idea of the difference between bull markets and bubbles, you have a whole blog post on this. And this is something that people have kind of been talking about with what's going on with AI. Like, are we in a bull market? Are we in a bubble? How do we know the difference? And you came up with 4 criteria that outline what the differences are. And I wanted to work through those individually and talk about them. And the first thing you had here was this idea of evolution. So how is the evolution different on a bubble than on a bull market?
Yeah. The most striking way is when you're in a bull market, I think people, all they talk about all the way up is valuation. You climb the wall of worry, as the saying goes. And then when you get to a bubble, when you evolve to that, because all bubbles have to start as bull markets, when you get to the bubble, you just stop talking about valuation altogether, or you just start using preposterous metrics. I mean, people joke about, user value or, the value of a minute spent online or something like that. Like you extract so far away from free cash flow, which I think is ultimately probably the best way to value any business. But, I think that's what happens in terms of the evolution. You worry about valuation forever, and then you just say, who cares? Like, let's go. It's bubble time. That's when things have gone pretty far.
How about timing? That was your second one. What's the difference with timing between a bull market and a bubble?
For a bull market, I think they can last years and years and years. So, you probably pulling in that idea of valuation, you're going to feel like you're too late pretty often, pretty frequently. And the reality is the bull market is probably just getting started. And I know we've also been in this period where obviously we've had generally downsloping interest rates for like 40 years plus. A lot of people have pointed that out. And so we've had a few strings here of very long bull markets. But even historically, I think bull markets tend to last years. Bubbles don't. I mean, bubbles don't last for years and years and years. Like if you look at the dot-com bubble, I would argue the bubble was only like 18 months, maybe 2 years, 1998 to when it burst in 2000. But for, 94 all the way up to 2000, that was the bull market that led into the bubble and then ultimately the bust.
How about psychology? This is something that's interesting because I would definitely think there's major differences in psychology between a bull market and a bubble. But if you asked me to explain it, I probably couldn't explain it that well. So what are the psychology differences?
I think that ties actually to kind of the first point of like the evolution. I think the psychology in bull markets, ironically, is a psychology of worry. It's like people are always thinking that things are too expensive. And like nothing's cheap right now, and it's hard to put money to work, even though the market just keeps going up. And so it just keeps pulling more people in. The psychology of bubbles is YOLO. I mean, it's 2020, it's 2021, it's crypto. And it's this feeling that like things will never go down, and it really pulls the broader market in. And I think that is the defining kind of difference in psychology between bull markets and bubbles, is that bubbles are a very sort of broad, almost like global phenomena. They've pulled in every investor you could possibly get interested in whatever the thing is that's really hot, which is definitionally, it's like, okay, you've got the last incremental buyer, and then all you can do is kind of go down there, and then more buyers run as asset prices decline. So I think that's the psychological thing, is that transition from worry to just euphoria. That's a pretty strong telltale sign you've gone from bull to bubble.
Yeah, when everybody else stops worrying, that's sometimes the time to start worrying. Or
Exactly.
the whole be fearful when others are, greedy when others are fearful, and fearful when others are greedy. The last one is, and I could kind of guess this too, the ending is probably very different for bubbles in that it's a lot worse, I would assume. But what did you learn around that? Like, how do the endings differ between bull markets and bubbles?
If you look at it, what you generally get is like bull markets can kind of end in these like longer, like more painful rundowns, I think. Or at least they feel drawn out and maybe more painful. And ultimately, like they get to a point that I think offers sort of like modest opportunities. You can finally buy assets for a reasonable price when you get through a traditional, let's say, bear market. And so it's just kind of like this long ride up and then a long ride down. At least it will feel long if you're a bull on the other side. With bubbles, I think it's much more acute up and then much more acute down. So you look at the correction or the bust really from Dotcom 2000 to 2000, late 2002, I guess 2003 is roughly where the trough was, if I remember. I think peak to trough was like 70%. And so when you have that large of a magnitude of a drawdown, the thing that's different, in my opinion, is that a lot of companies get thrown out with the trash, where you end up getting generational buying opportunities. I don't think you get the same level of generational buying opportunity just in a turn from a bull market to a bear market. So if you go back to .com, I mean, Amazon, right, is probably one of the most generational ones. And obviously they had things they did along the way. They went from just selling books to selling everything. They added AWS. So it's been an evolution as a company. And you throw Netflix in there too. Again, another one that was public in the .com era and now is one of the biggest companies in the world. So trying to find, when you do have the bubble burst, the real gems, like the truly magnificent companies with magnificent operators, both in the case of Netflix and Amazon, I think that's where you get incredible generational buying opportunities. And that's when you really need to be on the lookout and start buying stuff when it probably feels terrible because stocks are just going down every day.
You touched on two things that I wanted to ask about next. And one is this idea of the acute move up and the acute move down. It makes these things very, very difficult to invest in because the timing can be very hard. You've got these huge moves very quickly, and figuring out like how to invest and if it's even worth attempting to time it seems like it's a challenge. So like, as someone who invests in technology, how do you think about investing if we do get one of these bubble type environments?
I think it's a portfolio management question, really, and sort of a risk management question. Depending on how strongly you feel about where you are in the cycle, how much capital you would like to allocate to that type of risk, given your portfolio. I think those are the two dynamics that you really have to consider. And then obviously there is a chance you're going to be wrong. You might be too early. You might be a little bit late. You might get out a little late. But the goal, in my opinion, it's not to kind of call the top or call the bottom. I think it is still within the context of this massive move like this, instead of maybe a slow up and a slow down, you still want to find high quality companies, that you think are persistent winners in whatever the new technology is. So maybe some people feel differently about this, but like, I wouldn't go and just invest in the ESCOs as they call them on X. And sometimes those have some of the most parabolic moves up, but they also have the most parabolic moves down. Try to find really high quality companies. We mentioned Amazon and Netflix, quality companies with good leadership that you really think are going to be leaders for the long run. And then I think if you get to a point where you found a portfolio and you can build some of that allocation of your capital into those kinds of companies, and you're right about a bubble and things start to get a little crazy, you say, hey, like, I can't really justify this price on this company anymore, then you trim a little bit, or you pull out entirely and say, I'll get back in at a later date when I think it's a little bit more sane. But I think that's the only way to do it, is you really have to look at it in aggregate of the entire portfolio and think about how much risk you want to apply to that game.
Yeah, I would think that would be one of the more challenging things. Like, you probably have certain names you love the most. And in a bubble, you would expect those names, even the ones you love the most, to probably get above what you might consider fair value. And I would assume like handling that is probably one of the more challenging things, but correct me if I'm wrong about that.
The discipline to sell when things get crazy is super hard. And it's like we talked about in that framework of kind of like bull markets versus bubbles. You almost like literally have to write a note on your monitor every day to just say, like, remember, at some point you're going to stop caring about valuation. And it's like when you start to say, oh, you know what, like I thought that was expensive a couple months ago, and now it's like, I don't even care. That might be a sign that you should take some risk off the table and rethink some of those favored names, because it might be a local top or the top.
Another thing you alluded to is the idea that Amazon was one of the big winners from the previous bust, but there were a lot of companies that were not. I remember back in the day we had pets.com and all that kind of stuff. How do you think, like, investing today, if we're going to get into a bubble, how do you think about like figuring out what the eventual winners would be? And I'm sure you can't do that exactly, but what types of characteristics are you looking for in terms of companies that may be the eventual winners that end up, being great companies on the backside of it?
A couple things, and I would also offer a framework. Like there's usually kind of three phases, I think, when you think about new technological paradigms emerging into the market. The first phase is usually some sort of an infrastructure or CapEx build. So obviously we've been living through that with NVIDIA. The hyperscalers are spending tens of billions of dollars a year now on chips and infrastructure. So that's kind of phase one. Phase two, I think, is sort of like a data phase, and it can happen concurrently with phase one, but you're sort of organizing in this case, data is a component of intelligence for AI, but you're sort of organizing like the pieces and the tools in the information age to be able to extract value from that data. And then the third piece is the application layer. So things that hit end consumers, whether that be B2C, B2B, that's usually the final part. And like that, I think we're at the earliest parts right now of in AI. ChatGPT is the best example, but still, like we talked about earlier, not that many people use it in the grand scheme of things. So within that framework, what we try to do is think about, okay, you should construct a portfolio that has some pieces of each of those stacks where you have the most confidence. And it might change a little bit depending on where you think we are in the cycle. So if you were early and you had a good crystal ball, you probably should have been pretty heavy in infrastructure, maybe a little bit in data, not a ton in applications super early on. And then I think as the trend progresses, you're going to find that the data companies and then lastly, the application companies will be the ones that sort of get the NVIDIA bid. And hopefully they have fundamentals that are starting to support that bid too. But we kind of look at it in that framework in terms of what kinds of companies. And then below that, then I think you have, do they have good quality management teams? Do they have products that customers love and they can't get anywhere else? That's a question we like to ask a lot. And when you start asking those two questions, like, do I really trust the management team? And is this product truly unique? You get to a pretty small number of companies pretty quickly. And those tend to be the ones that do pretty well over the long run.
Do you think a lot of the biggest winners are companies that aren't public yet? I mean, I know you guys do both private and public investing. Do you think a lot of the biggest winners will come from the private world?
Right now, I am, I would say, more bullish about what I'm seeing in terms of opportunities in the private market versus the public market, particularly on sort of that data and application side. So I've been spending a growing amount of time in those two places and a little bit less on infrastructure. I still think there's probably a good amount to go on the infrastructure side, but trying to get ahead of kind of that data and application layer. I am really more excited at this point for the private companies versus public.
Just one quick thing on that. I'm wondering if, like, in some weird way, like I think back to like the late 90s, where you had all these internet companies kind of coming public and using the public markets for financing, and it didn't end well for a lot of those firms. But we've been in like this IPO drought, so I'm just wondering if, like, from a like overall like company development maturity standpoint, if that's actually going to be a like positive sort of in this environment versus what we went through maybe in the late 90s. I mean, I guess it depends on like what inning we're in, and it's eventually that bubble sort of forms. But I'm just, that idea of maybe companies being able to mature more because of this IPO like drought. I mean, maybe that's a good thing overall.
I think it can be. I think there's actually something there, Justin, that's interesting, and it ties to 2020 and 2021, oddly, where we just went through like the everything bubble. We went through SPAC mania, we went through crypto and meme coins, meme stocks, and we just had like this period of insanity. I've sort of had a thesis to your point that the next period of insanity, whenever that comes and whatever drives it, potentially AI, I actually wouldn't be surprised if more investors focus on higher quality names, period, where they say, look, like I got blown up by GameStop, and I got blown up by whatever random SPAC that, I bought. It went up 200% and then it went down 550%. Or it's not possible, it's negative, but 98%, let's say. I'll adjust my numbers. They probably felt like 550%. But I think you could see investors, you could see people say, I actually just want to invest in companies that I'm pretty sure are really high quality companies. They're not these weird, crazy SPAC things or meme stocks. And you might see, and maybe you're already starting to see it a little bit, you could argue with the Mag 7, like people kind of piling into known quality. They're going to have benefit from AI. They're high quality management teams that have great track records. And so I kind of think when we think about that IPO window opening, I wouldn't be surprised if maybe we get fewer companies coming out, but they do have real businesses attached to them, and they have really high quality, sort of forward prospects as early leaders or early winners in their spaces.
I want to ask you about the counter argument to this. I've kind of become a big believer in AI and what it's going to be. So I always want to challenge that by trying to find differing opinions. And I'll put up this tweet. I was just looking on Twitter for something, and I found this Ram Aliwalia, I think is the proper pronunciation of his name. But he was talking about this idea that in the .com bubble, you had a bunch of killer apps, whether it be email, e-commerce, the browser, digital music, internet gaming, like a lot of different things. And he was kind of saying those aren't there yet in this space yet. And I'm wondering, what do you think about that? He was saying, I can do fine without ChatGPT. It's not indispensable. So he's saying there's not as many indispensable things right now as there were like when the internet came. How do you think about that?
I think there's a couple of things. One is I think there's a little bit of revisionist history, because in 1995, you probably could have done fine without Hotmail, but like it did make your life better. It made communication better. And then by virtue and literally the nature of networks, which was the real innovation of the internet, those products all follow the sort of Metcalfe's law, right? Where as more people got on the network, email became more valuable, chat became more valuable. A lot of the products that the internet made possible were only mildly valuable in the beginning, when like 1% of the world was using the internet. They're super valuable when 90% of the world is using the internet. I think we're in a similar early stage now with AI. And I would argue, like AI, ChatGPT, Claude, which just put out a new model that I think is really impressive. And Gemini, Google, I mean, kind of the big three leaders in the model side, the chat side, they are kind of like the early Netscape, and like, it wasn't like Netscape was this thing that the second you used Netscape for the first time, it was completely indispensable. And you're like, I can never imagine life without Netscape. Like if you had to go back to just calling people and faxing people, you would have been able to figure it out. But I think with ChatGPT now, people are just starting to see that initial potential, and depending on how deeply you've experimented with it and gotten creative with it, I think it might color how much you say, yeah, like I couldn't imagine a world without that, versus kind of taking the skeptic's view and saying, well, yeah, I'm sure we'd be fine without it. You probably won't be saying that in 3 to 5 years. That would be my guess.
I think that's such an interesting point, because if we think 10 years in the future and we think what we're going to be doing with this technology, and if I had to guess that right now, I'm going to be completely wrong. There's going to be some mind blowing things we're doing that I never thought were possible. And email was probably the same exact thing. Like when it came on the scene, I was probably like, oh, email, that's great. And now it's like an indispensable part of life. So I think that's so important to put yourself back, like in your shoes at the time. And what did you think about these things versus, what we know now they ended up being?
Arthur C. Clarke has this quote, and I'm going to paraphrase it because I don't know the exact words, but he basically says, like, if we could actually predict the future, the future would probably disappoint us. Like if we could predict it accurately, because to your point, Jack, like we are always wrong. Usually we underestimate like how impactful, how amazing this stuff ends up being. And I think that just like, with the smartphone, when you had your first BlackBerry, I don't think anybody imagined having iPhones and then Vision Pros. And I think just like today with ChatGPT, as like crude and early as that might feel, like imagine what ChatGPT 10 looks like 10 years from now. It's going to be like, the original iPhone versus the iPhone 10. They won't be close.
Just one more for me before we switch to the AI stock picking stuff. And I was just wondering, like we did a podcast episode recently about the top 10 companies in the S&P 500. And when you go back historically and look at them, they always change decade to decade. What the indispensable companies from 40 years ago, quickly fell off that list. Many of them still existed, but they weren't the biggest companies anymore. And I'm just wondering, like, part of me thinks that may be changing now because the Googles and the Amazons, these types of companies are so dominant that maybe they will be, that powerful for decades. But then the other part of me says, well, I probably felt that way about DuPont and all that stuff if I was there back in the day. So I'm just wondering, since you're in this tech space, like, what do you think about that in terms of these companies' ability to continue to dominate and to continue to be the biggest companies in the world?
I love Templeton's quote about the four most dangerous words in investing are "this time is different." And then he adds that 20% of the time it actually is. So I actually think when we have a question like this, the question is sort of like, okay, well, what is potentially different this time such that it's not just a reversion to the mean kind of story? I think what's different is if you actually look, and we did this calculation recently, you look at the concentration of the S&P 500, the top 5 stocks in 2000. The top 5 were almost 20% of the index. They're about 9% of the total earnings. And the top 5 were, off the top of my head, it was Microsoft, Intel, Exxon, and Cisco. I'm pretty sure that's right. Now, top 5, they are 27% of the total index last time I checked, and they're about 20% of the trailing earnings. So it was almost double in 2000 when you think about the concentration earnings relative to weight in the index. Versus right now, it's not even 0.5% versus the double versus the 2x, or sorry, 0.5. And I think what's different, what those numbers tell me is different, is that these huge mega cap tech companies have captured so much value, so much more value. That's what's put them there. It hasn't necessarily been the decay of those other companies. I mean, Intel, Exxon, Cisco, these are all still really big companies, multiple hundreds of billions of dollars in market cap. And their businesses are bigger today than they were in 2000. But what's different is that Apple and Microsoft and Google and Amazon have created these just gigantic businesses that I think if you fast forward 10 years or 20 years from now, you kind of have to ask yourself, well, is somebody going to create a business that's even bigger than what these guys have created because that's how they would get ahead? Or is the business of some of these big winners going to decay? And I would say it doesn't seem likely in most cases that the businesses are going to decay. I don't really see a case where Microsoft now kind of being in the lead for AI cloud compute. I don't know why they would decay. Amazon is Amazon, right? Google with search. I know there's a lot of debate there and controversy. That one's maybe the one where you could say maybe OpenAI comes out and kind of displaces them. But I think it's just hard to imagine a world where these guys they create so much value in the world that they would be displaced, or that someone else is going to come out and create significantly more value in the way they did versus kind of the old guard 20 years ago.
For the back half of the conversation, we want to switch to your AI powered models because they're really cool and they're really interesting. But before we get into what you're doing with them, I just wanted to ask you at a high level, like if you have to compare AI as an investor to humans as an investor, what do you think the big advantages AI will have?
The biggest advantage I see is the lack of emotion. We talk about and just like studying Buffett, studying Munger. I feel like the corpus of their writings is partly about investing, but a lot of it is actually about human nature. And I think that as an investor, learning how to do a DCF, learning how to do basic fundamental investment calculation is pretty easy. Anybody can figure that out pretty quickly. Learning how to apply that and manage what your mind tells you to do is actually the whole job for your entire life. Like that's basically it. And I think that's why Buffett and Munger, Munger to his dying day, I think has sort of been consistently writing about understanding human nature of others and also yourself to be a great investor. And so what AI does that I think humans don't is they don't have to battle with that like inner dialogue, that emotion that, when the market's going up and you're not fully invested, you're frustrated, you hope there's a pullback. When the market's blowing up, you're not concerned, right? If it's AI. And I think that's something that when I think about AI participating more and more in markets, I think that's an advantage it will always have. Like it should always be able to weather storms, whether that is continue to stay long when things are bull market into froth and staying the course when everybody else wants to sell. I think AI will always be better at that than humans.
I've been thinking a lot about what it'll mean for the asset management industry. And in prepping for this, I was reading a blog post you did, which I didn't even know this thing about Elon Musk's process here, but you kind of compared what Elon Musk did to build Tesla and the process he went through. And you had like a big goal of saying like the same type of thing could be done to disrupt the BlackRocks of the world with AI. And can you just talk a little bit about what Musk's process was and how that kind of applies to that vision?
Yeah, Elon put out this master plan, he called it, in 2006, and he kind of tongue-in-cheek said, just between you and me, but it's a blog post for everybody to read. And so what he said in the post was sort of Tesla's mission, the founding mission was to accelerate the world's transition to renewable energy. And I think he's been pretty consistent about that for the last almost 20 years. When I think about the next 20 years, and how the investment world is going to change, I think AI powered investing is going to be a huge influence on that. So like last 20 years, it's been all about the shift from active to passive, the emergence of the ETF. And so next 20 years, I think kind of active and passive flows will actually go to AI powered strategies because I actually think they can beat markets and they can beat humans. When I think about the master plan, Elon's master plan was basically launch the Roadster, high price car, prove the market, then launch the Model S, more mass market, and then launch the Model 3, right? The big mass market car. And what I think about for this idea of a BlackRock for AI powered investing, how do you kind of inspire this transition from passive and active traditional management to AI powered management? I think you have to go out, you have to prove the product just like the Roadster did for Tesla, show people that AI can persistently beat markets with smart structure around it, and then start to put products into the world and use that money to launch more products. And ultimately, I think you will see at some point an AI powered version of BlackRock.
So can you talk us through, you have a number of strategies that you're tracking in real time. By the way, these are on thematic or gothematic.com. And you're calling these the intelligent alpha strategies. There's a number of them, but just at a high level, can you just talk us through what we're actually like seeing on this page?
I can. I'll give a little bit of brief history. This whole intelligent alpha project started when I was playing Curiosity, experimenting with ChatGPT last summer. So last June. And I sort of just started to wonder, well, can ChatGPT beat the S&P 500? Right? It's a pretty simple question, simple task. And it's turned in now to, I think I almost have 50 total strategies that I'm tracking. And so I have large cap focused strategies, mid cap, small cap, different sectors, different factors. You can kind of get AI to think like any kind of investor that you want. And the process I've developed is I use 3 AI investment committee. So it's GPT, it is Claude from Anthropic, and then it's Gemini from Google. And what I do is I'll say, for example, like let's create a large cap US equity focused strategy. We want to beat the S&P 500, super basic. I will get some basic data, fundamental historical data about earnings, revenue, growth, things like that. And I'll also pull some consensus data. I will feed that into the AI with a prompt that describes exactly what kind of investor I want them to think like. And that's the really important part. You have to give the investor a philosophy. That's actually what the purpose of the prompt is. Because if you just say, give me a portfolio of large cap stocks that have high growth, like it basically is just a glorified screener. And that's not very compelling. But if you say, I want you to think like Warren Buffett, right? And here's some things that Warren Buffett thinks. Here's some characteristics of companies that he really likes. Could be qualitative or quantitative. And then you have the AI choose portfolios. Then you start to get varied outputs between the three AIs that I use, number one. So they kind of do think differently when you give them, even if it's the same prompt and data. And then I'll take those outputs and I'll put them into a single portfolio. And that's the portfolio I then test against whatever benchmark I'm trying to beat.
And so are you looking, it's not a consensus-based approach, meaning you're not looking for overlap. You're actually just kind of taking these and then putting them together in one portfolio. And I guess removing the duplicates, obviously. Or maybe.
Yep. Basically, the way it works is each of the three committee members has a third of the weight of the portfolio. So if there is an overlap, if each of them have Apple at 1%, then Apple will end up at 1%. In that case, not, a third of a percent.
Right. So the AI is actually giving you an output. It's giving you weights. And then you could probably even go so far as, give it sector constraints, risk controls. I mean, you can build all that in, which is pretty amazing. And how often are you rebalancing, like monthly or quarterly, or what's the rebalancing frequency?
It depends on the strategy. So I have some that are more, I would say, somewhere between indexes and active strategies, where they're intended to be kind of long-term more static portfolios. They might only review twice a year or quarterly. And then they have other strategies that are intended to be a little bit more active that review monthly. But what I don't want to do is, like maybe more of a traditional quant approach where you're trading every day, you're looking at stocks every day. I think that game is really probably hard to play with generative AI models. I think generative AI models are really good as investors rather than traders. And so that's what I'm really trying to tune them as. So you don't really and shouldn't have to look at the portfolios as frequently.
Do you give it guardrails? So do you say, like, I don't want a position to be more than this percent or less than this percent of the portfolio, or I don't want any less than this number of stocks or more than this number of stocks? Do you let it figure that out itself, or do you give it guardrails around what you want it to do?
I do give it guardrails, and they sort of vary all the time depending on the portfolio. Usually they pay attention to the guardrails. Sometimes they don't pay attention to the guardrails. And that's one of the things I think that's so interesting. And sort of one of the things you learn working with AI is that even when you're like clear and explicit with what you want it to do, sometimes it will vary from that. And sometimes when it varies and has what we'll call a hallucination, sometimes that's like the most interesting thing, because you can ask it about it, or you can just take it for what it is worth. And like sometimes it will bring in stocks that don't fit for some reason, but they actually end up being like the most interesting ideas you see. You're like, why would it put that in there? And then you start doing your own work on it and you're like, I've never heard of this stock. It's really interesting for these three reasons. So the hallucinations and when it kind of disobeys you is actually the most fun part.
I think the fact that you started tracking these real time was important, because I mean, on the one hand, like I would want to know, like, if you could backtest this historically, what that would look like. But then on the other hand, it's like, I would wonder, would that be just a big exercise in data mining? And so, because the AI will figure out what the optimal strategy is. Like if you got a historical data set of fundamentals going back to like whatever, 63, which is the Fama French, which is when their original data set started. But I don't know. Have you thought about doing that on historical data and seeing what the numbers look like, or is that not really that interesting to you?
So actually, you make a great point, Justin. Like I think the way anybody would create stock strategies with generative AI, I think it would actually be impossible to backtest, because part of the output is giving it the data that you have as of right now. So you'd have to kind of manipulate your data back to a certain point in time. And depending on how far back in time you'd want to go, the models, the underlying models, right? Like, so Gemini, et cetera, have data into the future that would sort of mess up the exercise. So if you wanted to like backtest back to like, okay, what if I submitted this data to Gemini in, 2019 or something like that, you'd have to find a way to essentially pull out all of the training data that Google used from 2019 to 2023, I think is what Gemini is current to, and then have that model do it. That'd be the only way to do it authentically. So I think the answer to your question is all of these have to be done sort of bespoke in real time, looking forward, in my view, because the models are so dynamic, they're changing so much. And that is the exciting part, and the moat, in my opinion, is like all these models are changing so much. They do think differently. I think, at least I perceive them to be thinking differently as investors when I use them. And so different models actually are better, in my view, for certain kinds of investing applications than others. So finding the right model for your investment use case is part of where I think you can find alpha in the long run.
Are they all fundamental based, or are they doing things like reading articles about the company, reading annual reports, reading interviews with the CEO? Are they doing stuff like that too, or is it pretty much based on fundamentals and numbers?
Fundamentals and qualitative data that they would have in their training data set, to the extent, right? Again, I think ChatGPT or GPT and Claude, I don't remember where that one's current to, but I think they're all mostly current to 2023 or like mid 2023 now. So they should have some general understanding, or probably have some general understanding in their training data set about, companies' reports and perhaps some CEO interviews and things like that were publicly available that they'd pull in. But I'm not giving them like immediately current qualitative data. I only give them immediately current quantitative data.
Do you know anyone else that's doing this?
I don't. And every time I ask other people, have they heard of anybody else trying this? I haven't heard of anyone else who's really experimented to this depth. I've definitely seen other people try to get them to pick stocks, but really constructing the broader architecture to create, I think, products, because these models are scalable to create a full suite of investment products. I haven't seen anybody else do that.
So yeah, so your vision for this is, this could be the early stages of some type of investment firm or set of actual investable products that investors could someday have access to, potentially.
It's something we're definitely exploring. And I think it's been fun just to run the experiment again for learning purposes. I feel like I've learned so much about just AI and the potential for it. Back to our earlier conversation about like, how do you be an optimist? That's the biggest learning so far, is that we should be optimistic about this technology because it's very capable and it's only going to get better from here. But yeah, I think there is an audience from this. I do get a lot of people who email me and just say, hey, like, have you launched a product yet? And we're exploring that.
And do you know, I'm just curious, it's, there's not tons of performance history here, obviously, because, the longest ones would be coming up on a year, I guess, in June or something like that. And some of them were launched, later, but on a percentage, like batting percentage, like winning percentage versus on a strategy basis over its respective benchmark, how many strategies are beating their benchmarks?
So if I exclude a few of the really new ones that are just like less than 2 months old, I think is mostly just noisy data. It's about 73%. Last time I calculated it, the strategy is ahead of its benchmark. On average, the strategies are winning by about 350 basis points.
Yeah, that's pretty high batting average. Even if you were like 50-50 with that, it'd be pretty solid. So 70. Well, that's going to be interesting, Doug, to see sort of where that takes you and Deepwater, and, how investors sort of embrace that. The one thing, we talk a lot about like behavior and emotions. And I think that's, on the one hand, like it's great. AI and these types of strategies, they remove the emotional component. I think the other side of it is, if investors eventually invest in this stuff, when they don't produce outperformance, having the ability to sort of understand why, or like, that'll be important too. It'll be important, like, because, right now a human analyst might be able to articulate what happened in a portfolio, what happened in a strategy. But to be honest with you, probably in the future, AI probably will be able to just tell you, they'll be able to tell you exactly why. Like the chatbot will be able to tell you why it underperformed. And some investors, might accept that.
Yeah, you're hitting on the big question I get when I talk to potential customers. So I've done some customer discovery on this, and particularly on the institutional side, endowments, they want to know the answer to that question. Like, can I still trust this machine to perform? And so you need to have the explainability behind it. I think explainability is a really important concept in AI in general. But to your point, Justin, like, it will be even more so in AI when you need to make the decision. Do I still trust the AI to do the right thing with my money, or has it lost its edge?
This has been great, Doug. Two more just quick questions, one market related and then another about the future. So I'm just curious what your thoughts are. Do you think that there's a possibility here that AI, as more companies embrace it, it's sort of like adjusts profit margins higher? Like that's one thing I've kind of been thinking about. Like if you got a bump of, and I don't know, I'm just pulling this number out of a hat. I mean, margins are historically high, but if through AI, like you get 0.5 percentage point increase in margins, and then you think about, or maybe a full percent, I don't know, but whatever it is, and you discount all those future cash flows way in the future, that's a huge amount of wealth creation, sort of that can happen at the aggregate level. And I'm just wondering your thoughts on that. I mean, could that be the upside here with the overall market, that AI helps make companies more profitable and investors just, we're not seeing it yet because it's hard to believe that or see that. I'm just wondering your thoughts on that.
I think it will make companies more profitable. And I think we have one example recently with Klarna. There was some news out that they are using GPT to handle a good portion of their customer service inquiries. And I think the statistics they put out were something to the effect of like, GPT is doing the work of almost 700 human agents. So you could do some math to figure out how much money that might be saving a year. And they were reducing times from, call it several minutes, to like 1.5 minutes in terms of resolving a query. And so it's like, not only could you save money, but like even better, I think you can make the customer experience that much more impactful, that much more profound. So you kind of get a double whammy. And so I think we're going to see more things like that. And if we go back to this idea of infrastructure data application, we're still early on that kind of infrastructure, maybe getting a little more into the data side. It might still be a year or two before we see some of these applications more widespread and really impact the bottom line numbers. But I do think it's coming. I think it's something that investors will probably start to bake into numbers maybe more next year when we see it happening in the wild.
When you think out over the next 10 years, what parts of the world do you think will be most impacted by AI?
Geographically, what parts?
I just mean just over in general, like what, not geographically, like from our living our lives standpoint. I mean, there's so many different, you could go so many different places. So wherever you want to take it.
I think it will be, 10 years out, I think it'll be pervasive, and I think what's funny about technology, I don't remember who said this, but like great technology, it's actually like magic where you don't even realize you're using it. And so it's an odd way to answer your question, but I think in 10 years, like we don't think about pulling out our phone and the fact that like we're connected to the entire world. We've got all the information in the world at our fingertips. And that's kind of magical. Like it's not this crazy experience. It's just now part of our lives. And so when we zoom out 10 years, I know that AI will be interwoven into like everything we do, right? Like our scheduling on this, we probably would have never even emailed each other. It'll just be our AIs handling our calendar, sending links to get the podcast done, editing it, right? Like we probably just literally step on camera and then that's it. That's the end of the whole interaction. And it gets published to the web. So I think AI will do so many things, but we won't even realize it in 10 years. We'll be spoiled. But I think we'll hopefully remember this moment and say, oh, that was pretty cool. AI just did all that stuff for us. And it's only going to get even better from there.
Well, Justin, as the editor of this podcast, I like that vision.
Yeah. Your margins are going to go up.
Doug, I think that was an excellent way to answer that question. So thank you very much. It's always great to have you on. Such good thoughts. We really appreciate it. All the best. Thank you.
Thanks, guys. Good to see you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.